Welcome to this special episode on navigating the crisis. Joining us today, Chirag Mehta from Quantum Mutual Fund. Chirag, great to have you with us to get a better understanding, really, of how are you reassuring investors right now at a time, of great uncertainty on how to really ride out this crisis.
Yes, Abba, really it's unprecedented times in a way. These lockdowns we have never seen before, and it's having its own economic damage in its own way. So, but if you see from a market standpoint, these kind of dislocations are not really something new. Over last 26 years, we have seen 17 dislocations in equity markets, right from Harshad Mehta scam in 1994 to what we have seen in dot-com bust in 2000 or SARS episode in 2003, or be it the global financial crisis of 2008. We have seen many such dislocations. Some of them were unknown, like COVID, but there have been many dislocations in market which has had severe implications on financial markets. So from what we are telling investors is equity markets were expensive before COVID hit us. They were trading at multiples of excess of 25 times PE, which is significantly higher from 18 times the average historical multiples. So in a way, markets were looking for a correction, and COVID was more than a reason for them to correct. And therefore, markets have corrected now. So we are asking investors that this is the time now. It's come to reasonable valuations. You could start nibbling into market. The E quotient earnings is something which is still uncertain because we don't know what kind of economic damage and for how long it's going to be. And therefore, but it's time to start looking at markets, looking into equity allocations. And that is what we are doing in our multi-asset fund as well, which I manage. We have been increasing our equity allocations. Before COVID hit us, because of high valuations, we were running at 27% equity allocations of the portfolio. We have increased that now to 45%. So we, in a way, are increasing our equity allocations as and when we get opportunities. And that is the same thing we are telling investors.
Okay. What are you making of the global environment right now as well, Chirag, before we also focus further on equities? On one hand, we're still tracking the medical news and looking at possible recovery in tandem with that. On the other hand, US-China trade tensions continue to ride high.
Yeah, we are all fighting the pandemic in a way, and it's having its own impact on economy and equity markets. But this uncertainty, it's anybody's guess in terms of how long it's going to be. There are estimates that as summers hit the developed world, this could subside. Or there are other estimates that the vaccine will be developed in a 1 year's time, and this will be gone. So we are looking at a time frame which could be anywhere between 2 months to 1 year kind of time frame, and it's anybody's guess as how long that's going to be. But markets have been through volatility, and that volatility will continue. At one end, we have the issue in terms of the pandemic taking its toll. At the other end, we have governments and central banks trying to stimulate the economy, support the economy in their own way. So many global central banks or governments have done about 10 to 20% of their GDP as stimulus or liquidity supports. In India, we have still not seen that. It's still less than 1%. But in a way, this volatility will be there, but it is on the investors to take advantage of this volatility in their own way, having balanced allocation across asset classes. There will be uncertainty, but you need to take that uncertainty to your advantage by increasing your allocation slowly towards equities, which will be a long-term return generator. And on the debt side, you need to be careful in terms of what kind of exposure you take.
Okay. So talking about that, and since you've just touched upon it, at a time when equity markets are volatile, we've actually seen carnage in the debt markets and safe haven asset like gold doing relatively well. How would you advise one position an overall portfolio currently, which would be the opportunities and risks within each asset class?
Yes, all asset markets are bracing through uncertain times. If you see on the equity side, given that we don't know the longevity of this crisis, it is better to be with companies that have that ability to survive the crisis. So if they have a strong balance sheet, those are the companies that you got to get into, because when this crisis gets over, these companies will emerge much stronger. And therefore, you need to be with companies which have cash flows or cash in reserves that help them survive 2 months, 6 months, 1 year's time frame. When we did an analysis, most of the companies don't have cash flows to survive more than 9 months. So there will be winners that will emerge out of this. You need to back those winners and be invested in those companies. When it comes to debt, yes, we've seen some carnage in debt markets on the credit side, especially. So you need to avoid that side of the market for the time being, at least. You need to be in government securities and related assets which are not impacted by the crisis, because we don't know the company's ability to make payments with interest and principal that become due in this crisis. And therefore, we don't know what's more to come from this credit side. But so that is an uncertain area. So that is best to be avoided. When you're trying to increase allocation to equities, you're already taking some risk. You need not increase that risk by being on the credit side. And therefore, on the credit or on the debt side, you need to be in government securities. That is what we are doing in our multi-asset fund as well. We are in a dynamic bond fund, which doesn't take any private credit exposure. It just gets into GTEX and AAA PSUs, which are of critical importance for the government. So that is where we are positioning, and more on the liquid fund side, which is largely into treasury bills. So we are avoiding that credit exposure in our multi-asset fund for the time being. And lastly, gold has once again proved that it is an asset which is an excellent diversifier and helps during times of stress. If you see 1 year returns for gold are in excess of 45%. Even YTD, it's closer to 20%. So it is once again proved that it is an asset which you can rely on in times of crisis. Therefore, an allocation to gold per se looks much more attractive. If you see, global central banks have been continuously cutting rates, printing more money. As we see debasement of currencies happening in a big way, gold is one asset which cannot be debased at will by these central banks, and therefore will likely to do well. So from build an asset mix of equity, debt, and gold, gold is very important as an allocation. That is why we have a 15% allocation from the Quantum Multi-Asset Fund in gold. And therefore, one should have that balanced exposure so that you don't have to ride this volatility. For example, if you were measuring in the depths of crisis in March, equity markets had fallen by 28%. And if you had a mix of equity, debt, and gold, for example, a naive allocation of 40-40-20, you would have been less than 9% down. So vis-a-vis 28% fall, you're looking at just a 9% fall in a balanced mix of assets. And therefore, a portfolio mix always helps to ride the volatility that we see. And much of this volatility is going to be unforeseen. So brace for that volatility, but try to build an advantage of that volatility that you're seeing in the markets.
Now, given the high uncertainty and volatility that we're speaking about, and the fact that it's only going to continue to remain for a while until we have some clarity on how businesses are surviving this lockdown, should investors be in balanced or, asset allocation funds rather than pure equity funds? Is that what you would perhaps look at advising? Because given the track record that we've seen in the past, however, these funds haven't really always managed to protect investor capital.
Yeah, that's right. If you see a mix of assets is always helpful. We have seen time and again, if you see long-term return from a mix of assets vis-a-vis pure equity, you will get similar returns, but at very reduced volatility. And therefore, it helps you sleep peacefully at night. And therefore, having a mix of assets in place is always helpful. Having said that, if you have an allocation which is a biased allocation, so like if you have a very high proportion of one asset class in your portfolio, that's not going to do you a favor. Because if you see, most of these balanced funds have by mandate a 65% allocation at a minimum. They cannot go below that. So even if the fund manager doesn't like equity market valuations at that point in time, he or she cannot lower that allocation to less than 65%. And that is a problem with many of these balance funds. Since they cannot lower their allocation, they tend to get that volatility, and when the market declines, they also decline along with it. So there is some cushion, but that's not what the investors want. They want a more downside protection, which is not being offered by these balance funds because their mandate doesn't allow them to go below that 65% mark. And therefore, be in a mix of assets, but ensure you're in a mix of assets that's not biased towards any particular asset class. And that is the way you should go about investing.
So why were most balance funds, Chirag, having consistently 65% equity allocation if equities were overpriced over the last couple of years? That's the trend that we saw. Do you think that they compromised on their objective and effectively exposed investors to higher risk than they had agreed to take on?
If you step back, many of the investors went into balance funds when fixed deposit rates were on the decline. I clearly remember when it dipped below the 7% mark, many of the investors went in search for yields and found their answers into balance funds. But they were not ready to take that kind of risk exposure. Uh, they were looking at taking some higher risk as compared to fixed deposits, but they wanted just a little higher return. But they went into assets because equities were doing well. These balance funds were giving significantly higher returns. And therefore, they went into those balance funds. But the risk did not match their anticipation, or they were not ready for that kind of risk. And when markets have fallen or markets have turned to the corner, they are moving out of those kind of balance funds because that really did not match the risk profiles. So if you see many of these balance funds, because of equities giving higher returns over a long period of time, but at the same time, they are highly volatile. And given that they have a tax advantage over other asset classes, given after 1 year, you have a long-term capital gains tax of 10% vis-a-vis other asset classes, which have a 30% in the short term, but over 3 years, they have 20% with indexation kind of taxation. So to get that favorable tax element, as well as long-term returns from these equity as an asset allocation, they have a structure which has a minimum 65% allocation to equities. But that doesn't really match the risk profile that investors were looking for. And therefore, I mean, there was somewhere a mismatch between what these balance funds were offering vis-a-vis what the investors were looking for.
Okay, so is it fair then to say that these balance funds were then wrongly positioned as a safe, regular income generating product? And what would be the risk return characteristics of a truly balanced fund?
Sure. So if you have that 65% allocation to equities at a minimum level, you might be well into an equity fund, right? Because the risk return characteristics of an equity fund and a balanced fund with a 65% allocation won't be very different. If you see most of the equity funds mandate, their asset allocation also says that they are 65 to 100 in equities. So even so is for the balanced funds. So the risk return characteristics that investors were looking for was not really found in these balanced funds, right? So whenever investors are looking for a true balanced fund, it is to be non-biased towards a particular asset class. Like for the quantum multi-asset fund that we offer, it is 25-65% allocation to debt and equities. And therefore, it is not biased towards a particular asset class and gives the fund manager enough leeway, enough flexibility to move when the markets are not in their favor. And therefore, that is what investors should look for, a balanced allocation, which is not biased towards any asset class. And don't go for that tax benefit, because to save a few bucks on tax, you miss out, or you get that higher volatility which you're not prepared for. And therefore, look for a multi-asset fund or a balanced fund which is not biased towards a particular asset class.
Okay. Now, is it also true, Chirag, that AUMs in this category have been declining since 2018? As investors do realize that perhaps the product doesn't always suit their risk appetite and regular income needs, do you feel that possibly we could see further outflows on this front going ahead?
Certainly, I think think given that investors are realizing that it doesn't match their risk profile, and therefore they are doing the right thing of moving out of that asset class. Uh, if you see in 2017, when there were regular dividends being paid out by these balanced funds, and also when because equity markets were doing well, like in 2017, we had equity markets running up by 34%, right? And therefore, the lure of those returns pulled many investors into these balanced funds. So we saw 58,000 crores of money flowing into these balanced funds. But when tide turned, we have seen outflows. The next year, when they were not so high return generating or dividend paying, we saw outflows of 21,000 crores. And post that, outflows have just continued in these balanced funds. So I think investors made the right move in trying to move towards a mix of assets that could deliver the right risk and return for them. But the balanced fund was not the answer for them. And that is why they are moving out of that. And I think they should find some solution or what they are looking for in a true balanced fund or a multi-asset fund, which is not biased towards any particular asset class.
Okay. So which are the funds that you'd advise investors then to go for right now to protect their capital as well? And, your message to investors as well in balanced funds, who have lost, let's say, 12 to 15% this year?
Yeah, so balanced fund have seen a big knock because equity markets have fallen. They have fallen slightly lesser, but more or less in line with what equity funds have fallen. And therefore, investors, as I said, had made the right move to move into a mix of assets that could deliver as fixed deposits rates fall. And we have seen that fixed deposits have been a losing proposition. You could have some money, which is sacred money, which is safe money lying in these fixed deposits. But over and above that, if you have money lying in these fixed deposits, you're doing a disservice to yourself. And therefore, you need to move into a mix of assets, but don't go overboard. Like you went into balanced fund, you went overboard, taking a higher risk than what you were prepared for. And therefore, you need to move into assets which are not biased towards any asset class. Move into like funds like a multi-asset, like the quantum multi-asset fund, which is not biased, has an equal allocation, has enough flexibility for the fund manager, gives you that lesser volatility and a mix of assets. People tend to ignore gold. Many of these balanced funds don't offer gold as an allocation, but we have seen that gold is an important element of their allocation, and therefore a mix of all three assets will work perfectly for these investors.
Great. Chirag, I love the balanced approach that you're sharing with us. I think balance not perhaps being the right word, but the more holistic approach that you've shared with us today. What's the kind of return expectation that an investor should have from some of the possibilities that you've suggested? Keeping in mind, of course, that we're going through unseen times, and it might take a while for them to see the kind of returns perhaps that were being generated earlier.
Yes, as I said, markets will be volatile. Like even if we have not come out of this crisis, people are bracing for a rebound, a sharp recovery next year. And that is that optimism has been reflected in equity markets. So equity markets will go through the episodes of optimism and pessimism. A fund manager, which has the flexibility, will try to position itself when there is periods of optimism, they will reduce their allocation and try to book profits. When there are periods of pessimism, they'll go and buy into. And therefore, you could expect moderate returns, but at the same time, be prepared for slightly higher risk than what you are taking with your fixed deposits. And that is the key solution. It's kind of one-stop solution for basic investors' needs of investing. And that is the multi-asset funds that they could find answers to.
Okay. And coming more specifically to the markets and the kind of opportunities you see within equities currently, Chirag, is there a theme by which you're looking at investments currently, or a principle, or are you hunting for valuations, sector-wise? What strategy are you taking?
Yeah, there were many opportunities that came our way when markets have fallen significantly in the depths during March of this year. So if you see, what we are looking at is valuation has always been a key parameter. Another is governance that we look at very closely. And at these times of crisis, we are looking at the balance sheet's ability to survive the crisis. There will always be winners in a particular sector. companies that are well managed, who have built for this rainy day, uh, who have cash which can help them meet the fixed expenses, and therefore there is no doubt on their ability to survive the crisis. And therefore, we will try to back these kind of companies which are available at a better valuation, have cash to survive, and are great governance companies. So these are the companies that we are looking for and scouting for in these kind of markets. And I think there will be many opportunities that will come our way to buy these leaders.
Which are the pockets, from your vantage point, Chirag, that you see recovering faster than others? Of course, the bigger companies, the better run companies will survive. But also from an economic standpoint, when you're taking a look at sectors, and some of them, of course, we all know will be very badly hit. Which are some of the pockets that you actually see emerge a little better, a little less bruised?
So at the same time, because of this crisis, we are looking at niche businesses which have lesser competition and therefore will kick back faster. Uh, so we are looking at many opportunities, like be it because there will be government spending come in a big way to support the economy, and much of that could be infra-led. So there could be pockets like cement sector, or be it any other sector related to the infra spending, related to what government will kind of start to kickstart the economy. So there are various sectors, especially we're looking at niche sectors, and we are looking at something which is very close to in terms of what can really move fast if the government wants to kickstart the economy in a big way.
In your opinion, or from some of the work that you've been doing at Quantum, Chirag, what's the sense that you're getting from the people that you're speaking to, from the research reports that you also have, in terms of how long this is going to take to really see a real recovery?
So yes, recovery will take some time because the kind of closures that we have seen and kind of the hit that companies will take in terms of there will be debt kind of increasing at the corporate level, at the individual level, and at the government level. And therefore, this debt overhang will ensure that whatever recovery we see in markets is going to be slow and gradual. So we might see a demand spike immediately when things open up because people will go out, spend, and post that demand spike, we see a gradual recovery, unlike what others are predicting, which is a kind of a very V-shaped recovery, which we don't think is the likely case. So that is how we are planning, looking at companies, looking at the macro environment shape up, and so we are not buying into that euphoria that there is going to be a V-shaped recovery and bracing for a gradual recovery.
And within your sectoral allocations, would you also be reshuffling within that currently, or are you still waiting to see how earnings play out?
So we are reshuffling as and when we get an opportunity per se, but largely we are looking at companies, as I said, which can survive the crisis, and therefore will give us more comfort in their ability to bounce back. Plus, these companies will be bracing for a lesser competition because many of the competitors may get weeded out because of the crisis. And therefore, these are the kind of companies that we are scouting for in terms of their ability to survive, and therefore, and a niche business to kind of see that they recover faster than what many anticipate. So in a way, yeah, we are bracing for a gradual recovery, and in that we are trying to we will of course look at earnings, what kind of earnings come out of these companies and how badly they are hit because of the revenue loss that they're seeing. But we will try, when that happens, valuations for these companies will get much cheaper, and if we see that their ability to survive the crisis is in place, we will kind of buy into those.
Okay. Some really sound principles coming in, especially for a long-term investor. Remember, market movements like these, the current volatility, uncertainty, and the ups and downs are powerful, of course. Chirag, thanks so much for sharing with us, a complete breakdown really of how one should approach investing in these current times. It was great speaking with you today, and thanks for joining us as well. And thanks for watching, everyone out there.
Thank you, Abba. Pleasure.